How to build portfolio resilience before the next crisis. It always begins the same way, quietly. A few worrying headlines, a sudden drop in the market, a bank under pressure, an unfamiliar word repeated across financial news until it becomes impossible to ignore. Contagion, liquidity crisis, emergency intervention, recession, and then suddenly, people who believed they were long-term investors discover they were only confident during bull markets. In 2008, retirement accounts were cut in half. In 2020, global markets collapsed faster than almost any period in modern history. Entire industries froze. Fear spread faster than the virus itself. And every single crisis reveals the same uncomfortable truth. Most portfolios are not designed to survive stress. They are designed to maximize optimism. Market ticker sounds. Silence. But resilient investors think differently. They understand something most people learn too late. The first objective of investing is not getting rich. It is surviving long enough to compound wealth over decades. Because in investing, the investors who survive crises usually inherit the future. There is a dangerous illusion that forms during stable economic periods. When markets rise consistently, when technology stocks soar, when everyone online appears to be making money effortlessly. Risk becomes invisible. People begin confusing momentum with skill, aggression with intelligence, concentration with conviction, and slowly, portfolios become fragile. Not because investors are irrational, but because human psychology is not naturally designed for uncertainty. We are wired to chase what recently worked. We are wired to fear missing out. We are wired to panic when losses appear, and financial markets exploit all of it. This video is not about predicting the next crisis. Nobody can do that consistently. This is about something far more important: how disciplined investors prepare before uncertainty arrives. Because history suggests something uncomfortable. Another crisis is not a possibility. It is a certainty. The only unknown is the trigger. Why most portfolios collapse under stress. Most portfolio failures do not begin with bad investments. They begin with emotional reactions. The market drops 20%, then 30%. Then panic accelerates, and suddenly investors begin making decisions they swore they would never make, selling near bottoms, liquidating retirement accounts, abandoning long-term strategies, and moving entirely to cash after the damage is already done. This is the psychological core of every financial crisis. Fear changes behavior faster than facts do, and behavioral economists have studied this extensively. One of the most powerful concepts is loss aversion. The pain of losing money psychologically feels far more intense than the pleasure of gaining it, which means during market crashes, investors often stop thinking strategically and start thinking defensively. They no longer ask, "What is rational?" They ask, "How do I stop this feeling?" And that single shift destroys portfolios. During the 2008 financial crisis, many investors sold near the bottom after years of gains had already evaporated. Then they remained on the sidelines during the recovery. The market eventually recovered. But many portfolios never psychologically recovered with it. The same pattern happened during the COVID-19 crash. In March 2020, global markets collapsed with terrifying speed. Airlines shut down, cities locked down, financial news became relentless, and millions of investors panic-sold directly into extreme uncertainty. Then came one of the fastest recoveries in modern history. The lesson is uncomfortable. Crises do not only test portfolios, they test emotional endurance. Wealth preservation versus wealth chasing. There is a major difference between building wealth and keeping it. Bull markets convince people that maximum returns should always be the goal. But experienced investors understand something deeper. Returns without survivability are meaningless. A portfolio that collapses 70% may mathematically require enormous gains just to recover. A 50% loss requires a 100% gain to break even. That is why resilient investors think in terms of risk-adjusted returns, not just raw performance, because avoiding catastrophic damage is often more important than maximizing upside. This is why institutional investors, pension funds, and endowments rarely operate like speculative traders online. They prioritize durability, liquidity, diversification, capital preservation, volatility management, because large pools of capital understand a fundamental reality. If you cannot survive the storm, you cannot benefit from the recovery. The illusion of diversification. One of the biggest misconceptions in investing is diversification. Most people believe owning multiple stocks means they are diversified. But during crises, correlations change. Assets that appear independent during normal periods often fall together during panic. This is called correlation risk, and it becomes brutally visible during systemic stress. In 2008, multiple sectors collapsed together. In inflation shocks, both stocks and bonds can struggle simultaneously. In liquidity crises, investors sell whatever they can, not just what they want. This is why surface-level diversification is not enough. Real diversification means understanding how assets behave under stress, not just during prosperity. A resilient portfolio often includes multiple layers of protection, domestic and international exposure, different asset classes, cash reserves, inflation-resistant assets, defensive sectors, possibly commodities or precious metals depending on risk tolerance, a short-duration fixed income, and position sizing that prevents any single mistake from becoming fatal. Because resilience is not built from prediction, it is built from preparation. Cash is not laziness. During euphoric markets, cash looks foolish. People mock caution. They ridicule defensive positioning. Holding liquidity feels unproductive while speculative assets surge. But crises completely redefine the value of cash. Cash is not only protection, it is optionality. It allows investors to survive job losses, unexpected emergencies, medical costs, economic shutdowns, and perhaps most importantly, it allows rational action during irrational moments. When markets crash, investors without liquidity often become forced sellers. But investors with reserves gain flexibility. They can rebalance, accumulate quality assets, avoid panic decisions. Warren Buffett once described cash as oxygen. You do not think about it constantly until you suddenly cannot breathe. Pause. Portfolio resilience is not about being permanently defensive. It is about maintaining enough flexibility to withstand uncertainty without emotional collapse. Inflation, the silent portfolio killer. Some crises arrive violently, others arrive slowly. Inflation is one of the most psychologically deceptive economic threats because it destroys purchasing power gradually. At first, it feels manageable. Then groceries cost more. Housing becomes more expensive. Energy prices rise, savings lose real value. And eventually, investors realize something painful. A portfolio growing slower than inflation may still be losing purchasing power. And this became especially visible during the global inflation shock following the pandemic era. Massive stimulus, supply chain disruptions, energy instability, labor shortages. The result was inflation levels many younger investors had never experienced before, and suddenly, traditional assumptions stopped working. This is why resilient portfolios consider inflation resistance, not necessarily through extreme speculation, but through intelligent exposure to productive assets. Historically, equities have often outpaced inflation over long periods. Certain real assets can provide partial protection. Pricing power businesses tend to adapt better than fragile companies. But again, the objective is not perfection, it is resilience. The psychology of panic financial crises are never purely economic events. They are emotional contagion events. Fear spreads socially. People absorb panic from headlines, from social media, from coworkers, from family members. And during extreme volatility, human beings instinctively seek certainty. This is why bad financial decisions cluster during stressful periods. Investors abandon plans, increase leverage recklessly, or flee entirely into fear. Behavioral finance repeatedly shows that investor returns often underperform investment returns because of poor timing decisions. Not because the assets themselves failed, but because emotions interrupted discipline. Pause. The market is one of the few places where panic feels responsible in the moment and becomes destructive in hindsight. This is why resilient investors build systems before stress arrives. Automatic investing, predefined allocations, rebalancing rules, emergency reserves, position limits, because systems reduce emotional interference, and during crises, reducing emotional interference is a massive advantage. Stress testing a portfolio, dark screen, hypothetical scenarios appear. Narrator. Here is a question most investors never ask themselves. Could your portfolio emotionally survive a 40% drawdown? Not theoretically, emotionally. Could you continue investing if unemployment rose sharply? If markets remained weak for years? If your portfolio stopped growing entirely for an extended period? Because resilience is not just mathematical, it is behavioral. A portfolio only works if you can stay invested through stress. Experienced investors often mentally stress test portfolios against multiple scenarios: a recession, a prolonged inflation cycle, a banking crisis, a geopolitical conflict, or a housing downturn, a technology bubble collapse, not because they can predict them, but because they understand uncertainty is permanent. And interestingly, the strongest portfolios are often slightly less exciting during bull markets, because they are designed to survive full economic cycles, not impress people temporarily online. Fragile versus resilient portfolios. Imagine two investors entering a crisis. The first investor concentrated heavily into speculative growth assets after years of strong returns. No emergency fund, high leverage, no diversification, no liquidity strategy. The second investor built more slowly. Diversified exposure, cash reserves, controlled position sizing, long-term allocation discipline, risk awareness. Now the crisis arrives. Markets fall sharply. The fragile portfolio collapses under pressure, not only financially, but psychologically. The investor panic sells, stops investing, becomes consumed by fear. But the resilient investor behaves differently, not because they feel no fear, but because the portfolio was designed with uncertainty already in mind. And this distinction matters enormously, because crises eventually end. But investor behavior during crises often determines long-term financial outcomes for decades. Black swan events and anti-fragility. Some events cannot be forecasted precisely. Pandemics, wars, systemic banking failures, sudden geopolitical escalations. These are often called black swan events, rare, high impact, deeply disruptive, and while predicting them consistently is nearly impossible, building fragility around the assumption they will never happen is dangerous. And this is where the idea of anti-fragility becomes powerful. Some systems break under volatility, others adapt, and some actually strengthen through stress. Resilient investors focus less on prediction and more on adaptability. Can the portfolio survive uncertainty? Can cash flow continue? Can opportunities be captured during panic? Because historically, crises often create extraordinary long-term opportunities for investors who remain solvent, rational, and patient. Rebalancing and discipline. One of the least exciting investing habits is also one of the most powerful: rebalancing. When one asset class dramatically outperforms, portfolios quietly become riskier over time. A disciplined investor periodically restores intended allocations, and which often means doing something psychologically uncomfortable, selling portions of what recently performed best and buying what recently underperformed. This feels unnatural, because human psychology prefers momentum and confirmation, But rebalancing forces discipline into portfolio management. It systematically reduces concentration risk. And during crises, discipline becomes more valuable than prediction. The long-term reality. Most investors ignore. Many investors unknowingly build portfolios designed for ideal conditions: stable growth, low inflation, low volatility, strong employment, cheap liquidity. But economies move in cycles: debt cycles, credit expansions, recessions, recoveries, speculative bubbles, policy tightening. And every generation eventually experiences a moment where financial assumptions break unexpectedly. And that is why resilience matters. Because investing is not merely about maximizing gains during easy periods. It is about maintaining financial continuity across difficult ones. The market rewards endurance more consistently than brilliance. And sometimes, the most intelligent financial decision is simply refusing to self-destruct during uncertainty. Here are some principles many disciplined investors use when preparing for uncertainty. 1. Maintain an emergency reserve. Avoid becoming a forced seller during crises. 2. Diversify intelligently. Think beyond owning many stocks. Understand correlation risk. 3. Avoid excessive leverage. Debt magnifies emotional pressure during downturns. 4. Use position sizing. No single investment should destroy your financial future. 5. Rebalance. Periodically prevent hidden concentration risk from accumulating. 6. Focus on time. Horizon short-term volatility matters less when liquidity needs are managed. 7. Continue learning. Economic conditions evolve. So should your understanding. 8. Separate emotion from process systems. Outperform panic. 9. Think in probabilities, not predictions. 10. Prioritize survival. Because surviving crises is what allows long-term compounding to work. One day, another crisis will arrive. The headlines will return. Fear will spread again. Experts will disagree. Markets will fall faster than people expect. And millions of investors will once again discover the difference between confidence and resilience. But the investors who endure are rarely the loudest, rarely the most aggressive, rarely the most euphoric during bull markets. They are usually the most prepared. Because resilient investing is not built on certainty, and it is built on humility. The humility to accept that markets can break unexpectedly, that economies can change suddenly, that fear can overpower logic, but also that discipline compounds quietly over time. In investing, survival is not defensive weakness, it is strategic strength. And those who remain rational during chaos often gain something far more valuable than temporary returns. They gain longevity, because ultimately, the goal is not simply to grow wealth, it is to build a financial life strong enough to withstand reality itself. If you found this valuable, subscribe for more deep-dive finance documentaries on investing psychology, economic resilience, and long-term wealth strategy. And in the comments, what do you believe is the biggest threat to modern portfolios right now? Inflation, debt, market bubbles, AI disruption, geopolitical instability? I'd genuinely like to hear your perspective.